Okay, number 6, and I'm sorry if I sound raspy. I'm still battling my awful cold, so I'm still rasping here. Okay, so Bob Company has some transactions related to notes receivable for the last 2 months of 2012. And we're going to just go ahead and journalize the transactions initially. So on November 1st, he loaned $10,000 cash to Jake Hall on a 1-year 5% note. So on November 1st, we're going to go ahead and debit notes receivable for that $10,000 and go ahead and credit cash, right, we borrowed him $10,000 for the $10,000. On December 11th, sold goods to Abe, receiving a $5,000 60-day 4% note. So December 11th, we're going to debit notes receivable for $5,000 and credit cash again for $5,000. On December 16th, received a $2,000 4-month 5% note in exchange for A Company's outstanding accounts receivable. So, December 16th, we're going to go ahead and debit notes receivable for $2,000 and credit cash for $2,000. December 31st, accrued interest revenue on all notes receivable. So now we've got to figure out the interest. So, let's go ahead and figure the interest out here for each account. Okay, first of all, let's go ahead and look at Jake Hall. We have a $10,000 note. We're going to multiply that by our interest, which is 5%. His note is a yearly note. It was obtained November 1st, so 2 months of interest is owed, right? November and December. So we're going to multiply by 2/12, and that will give us, I'm rounding, it's 83 and some change, but approximately $83. So that's our first interest. Second interest, we have Abe receiving a $5,000 60-day 4% note. So let's look at how we're going to calculate that. It's a daily note, right? When we calculate days, we do not count the day of issue, but we count every day after that, including the date of payment. But let's go ahead and look at how many days there have been. Well, there's 31 days in the month, right? 31 days in the month. And we sold this on the 11th. So that means it's been around, 31 minus 11 is 20. So it's been around for 20 days. So let's go ahead. And that note is for $5,000. The interest rate on that note is 4%. And that's going to be for 20 days. We're going to use 360. And that's what we're using, I believe, according to the book. So we're going to use 360 as our base. And if we multiply 5,000 by 4% by 20 over 360 days, we get approximately 11. Again, it's 11 and some change. We're just going to use 11. Third note. We received the $2,000 4-month 5% note. Okay, this happened on December 16th, right? So that's about a half of a month. So that's how we're going to have to record it. So it's going to be 2,000 times 5% times 0.5 divided by 12. It's a half of a month, right? So 0.5 divided by 12, and that will give us about $4. Again, it's $4 and some change. We're just going to make it 40. So now to find out about our accrued interest, we're going to add these three together. So 83 plus 11 plus 4 is $98. So let's go ahead and record that. So we are going to have, and this is on December 31st, we are going to have interest receivable, because that interest is owed to us, $98. And we're going to have interest revenue of $98. So let me get rid of all this. I hope you've copied it. So that's what those are what our transactions look like through December. Now what we have is we are going to record the collection of Hall's note. That's our first note. So the collection, when it's due, is going to, of course, be the year 2013. And it's due in November, on November 1st. So let's go ahead and see what we're going to get here. First of all, we're going to get cash, right? But how much are we going to get in cash? We're going to get the note receivable plus interest. So they owe us 5% interest, and it's a 1-year loan. So $10,000 times 5% is going to be $500. So the cash we're going to get is going to be $10,500. Our note receivable, we need to take that off the books. The note receivable is $10,000. Now we have to account for the other $500. We already accounted for some of this revenue last year, remember? We accounted for, when we figured it out, I've erased it, but when we figured out Hall's amount, it was $83. So, 500 minus 83 leaves us $417. So that's the revenue we still need to account for, $417. So we'll go ahead and credit interest revenue for the $417. And we'll go ahead and credit interest receivable. Remember, $83 for Hall was part of this $98 of interest receivable. Well, we need to clear that off our books, right? We've got $83 of that money, need to clear it off. So we're going to go ahead and credit interest receivable. We debited it initially, now we have to credit it for the $83, and that's going to take Hall's $83 portion of this $98 out of interest receivable. So, that's all there is to it. That should take care of number 6 for you. If you have any questions, please call me or write me. Have a good week, everybody, and use this to help you with homework number 6.